Good morning, everybody, and thanks for joining us for the China webinar this morning. Apologies for being a little bit late. We were just signing in and getting set up. Welcome, Tian. Thanks for joining us in person in South Africa from Shanghai.
Nice to be here.
Yeah, good to have you, and thanks to everybody for joining. I see we've already got 152 people joining, which is fantastic. Obviously, a very exciting topic. China-America relations, tariffs, there's lots to talk about. Tian has already been out in South Africa for a couple of days already, talking to clients, but a great story, lots of geopolitical narrative around this, and look forward to hearing what you have to say. I'm sure there are going to be lots of questions. I've already got a few questions teed up for Tian for the end of this presentation. So folks, please remember to type your questions on the side. I think what we'll do is let Tian run through the presentation, and then we'll address the questions as we go along. Maybe to start, Tian, I mean, as I said, a highly exciting period. Donald Trump and Xi Jinping met yesterday. I think the relations are starting to look a little bit better. We've certainly seen the market reaction to the softening of tariffs, and hopefully some agreement is reached. But obviously, global trade is at the center of all of this. Look forward to hearing what you have to say, and no doubt some of the questions are going to be very thought-provoking at the end of your presentation.
Looking forward to the question. Thank
you. Yeah,
good.
Over to you.
Morning, everyone. It's great to be in Cape Town. I think I caught some of the best weather of recent weeks. So very fortunate and happy about that. I'm going to be sharing with you all what was a bit of a boring quarter in terms of quarter three until the first week of October, where a lot of action actually took place. So I'm going to jump straight into the presentation. Please feel free to type questions into the chat box, and then we'll get to it as per our webinars previously. So firstly, I think what happened in the first week of October, obviously China really tightening the screws in terms of rare earth controls after the US Commerce Department started sanctioning more Chinese companies. So by our account, our internal research, around 2,200 companies, Chinese companies, are now sanctioned by the US, about 400 odd additions just in 2025 alone. And when China responded with the strong rare earth controls, Trump obviously threatened with another 100% tariffs. But the problem with the tariffs is we've already been there. We recently came down from the 165 versus 145 sort of tariff rates. Now we're back down to a combination of tariffs getting to 55% prior to this week. And now we're at 45% for Chinese goods into the US and 10% for US goods into China. So obviously the tariff threat is losing credibility as we go along. This was from this picture from their recent meeting in Korea, literally yesterday. As I mentioned earlier, tariff threats are losing credibility. We were expecting all of the 20% of the fentanyl-related tariffs to be removed. It was a bit underwhelming that only 10% of that were removed, but nevertheless, it's a positive market development, so pretty good. I think one thing we need to really pick up sort of our attention to is that from the most recent meetings between the two presidents in Korea, there were no Chinese concessions made to the US. And this is obviously linked to the title style. And in terms of the trade negotiations, China is now in the driving seat, and China is very much in a position of strength because they've been sanctioned since about 2018, and China has largely already become sanction-proof after 7.5 years of hard work. Not in an amazing spot compared to if global trade had continued to freely flow and no restrictions existed, but China very much do not need the US as much as the US needs China now. So that's why the rare earths controls have not been loosened, but the US gave up 10% of the fentanyl tariff. So this is a very strong indication of the direction that we can see going forward. So very positive development for China, actually very positive development for global markets. Unfortunately, I think non-China related, the markets are less optimistic when Fed chairman came out to say there's no guaranteed rate cuts for the rest of the year. That's probably affecting markets more. But overall, from a China perspective, we are still optimistic. Everything's going as expected, although not as good as expected in terms of just the tariff rate cuts. if we look at some data just showing why China is so firm in its response to US trade measures, is that they they really don't need the US as much as before. So if you look at the green bars on this chart, it's monthly exports to the US from China, and you can see very clearly since the beginning of 2025, these green bars on average dropping. So relative to 2024, we are seeing on average almost a 25% drop in exports to the US. While we don't think is absolutely reduction in exports to the US, a lot of this drop will be shipped to third countries who then ship to the US to take advantage of lower tariffs. But overall, if you look at the blue line, which is less apparent, the blue line is actually linked to the left axis. It's very much growing. So Chinese exports are growing as fast as ever, as in terms of overall exports to every place in the world, but exports to the US are declining. So Chinese exports are less and less dependent on US as an economy. Overall, we are heading towards that 10% mark. So 90% of China's trade happening with the rest of the world, only 10% with the US. If we look at Chinese purchases of US soybeans, obviously there's been announcements of some minor soybean purchases from China of US soybeans, but the pressure has really been turned on since May. So if you look at customs data, you don't necessarily see it. And this chart will be coming out in our quarterly commentary where I discuss it a little bit in detail, is that even though China has been taking delivery of US soybeans every month of this year, it's all been part of historical purchases. There have been no new purchases as of the week of May 29th this year. That's why Trump has been talking a lot. It's a lot of his voter support base.
Yeah, sorry to interrupt here. What I was saying, it's an important farming product of America. So in trying to make America great again and getting the farmers to farming, now you've got a product that's core to their, potentially core to their farming produce. And the biggest buyer just says, thanks very much. We'll go and source from Brazil and the rest of the world.
Yeah, absolutely. I mean, if you look at purchases from Brazil, it's covered in our commentary that will hopefully come out early next week, is that just last year, Chinese purchases of Brazilian soybeans were 3 times the amount of US soybeans. So in effect, you literally need Brazil to up their production by 30% to sort of replace the entire US supply. And from a pure geopolitical perspective, China has all the tools to do that. And it's not a difficult task as compared to rare earths, as an example, where it is very, very difficult to get a replacement producer of rare earths compared to China. So this is something, obviously, again, another data point that shows why China is in a position of strength in terms of the latest bilateral relations and the trade negotiations. Okay, and I think that's a summary of the geopolitics pretty much for October. It's quietening down, and hopefully we expect more positive development. So rumors are that there will be official state visits between China and the US next year. And in preparation for that, we're expecting more good bilateral news to come out. So in terms of geopolitics, we actually, it's a good thing that China is now in a position of strength. We expect less shock to the markets and more positive and constructive engagements between the two companies. Moving on to the latest data in the market, I think I'll run quickly through. It's really nothing exciting. I will point to the positives and the negatives. Everything's color coded. So green is fairly positive. GDP growth at 4.8%. So we're very much going to reach the 5% growth target this year. The good news is that we're going to reach 5%. Bad news is that we probably don't expect more stimulus from the government for the rest of the year, at least until 2026. But at growth of 5%, you don't need stimulus. Inflation, not positive, but we're not too concerned about inflation. So inflation ended a positive streak, but it has been hovering around 0. It is one of the problems of the Chinese markets right now. But the positive is that core CPI continues to accelerate. Core CPI is now hitting the 1% mark. You're pretty much on target. Core CPI getting to about 1.5% is probably the ideal situation for China. So inflation is recovering. So we're not too concerned.
So can we just go back to that? I mean, the inflation that you're saying is not positive. How do they engineer the inflation and why is it important?
So, I mean, if you have persistent deflation expectation, and that's, I mean, the most dangerous thing probably from a consumer perspective, especially in China where consumers are already reluctant to spend. So if you have persistent deflation and people expect vegetables to get cheaper next year,
They hold off. They hold off consumption.
They just consistently hold up, and it's actually just a more and more negative drag on the economy. So that's what we want to avoid. Hovering around zero is not as concerning, especially when our core inflation is growing. So obviously, CPI itself includes cyclical items like energy and food, etc. And that's what's declining in price.
And the other story is that China exports deflation. So obviously that's a problem for the rest of the world as well. The goods are just constantly getting cheaper and cheaper.
So for the rest of the world, it's actually not a bad thing because the rest of the world is battling with high inflation. So it's
correct.
For example, South Africa is at historical low inflation. I think the latest reading about 3.4%, compared to the historical averages closer to 6%. So the rest of the world still have healthy inflation. It's actually the deflation coming out of China has actually helped the rest of the world from high inflation to more reasonable inflation. I think one of the things that's hindering sort of China exporting deflation to the world is that their currency has remained relatively weak, especially in facing the trade restrictions, etc.
So that inflation story is around internal consumption, and the point that has been made many a time is that you want the Chinese consumer to consume more of their own goods, which is good for the internal consumption rate, internal for their own industries, etc., etc.
Yeah.
Okay. So that hence just clarifying the internal consumption and see inflation rate why being low is a problem.
Yeah. So PPI is low. It is probably the most concerning data point because it's been negative for a long time, but we are seeing a reduction in the PPI drops. So that's getting better.
I keep interrupting, but Chinese internal sentiment. Obviously, sentiment is a great indicator of whether that consumption rate may turn at a certain point. What does that look like at the moment?
I think definitely getting better. People are still sort of, I guess, worried about the future. I mean, especially coming out of COVID, coming out of property slump, so COVID, property slump, stock market crash, everything happened at once. And with that, obviously, a lot of unemployment as well. So everything got grouped, every bad situation got grouped together in the last few years. And right now, obviously, the stock market crash has ended. We are having a strong rally in the market. Property declines are sort of flattening. We still not bullish on properties. I actually have it on my next slide. I'll just run through the points. And overall, consumer sentiment is improving. So what we see on the ground is that the malls are no longer sort of half empty. Shopping areas, streets, restaurants, they're all full. Unfortunately, if you look at the first point on this slide, is that retail consumption is growing, but not growing as quickly as we'd like. So that 3% year-on-year growth, we'd like it to be around 8 to 10%. So it is lagging a bit. This year is probably between 3 to 6% on average. So in line with GDP growth target, but you want the Chinese economy if you want the Chinese economy to switch from investment focus to more of a consumption leading economy, you want your retail consumption to be growing at a faster pace than your GDP growth. So that's, I think, where the government's trying to push. There are a lot of government subsidies buying electronics to eating out, etc. So the government's putting in a lot of fiscal budget towards that. So that's helping.
So, Tian, we've spoken again a lot, and I guess the listeners watching us today on this webinar, which the home price story here is it's got to be at a certain point that those prices become affordable and people re-enter the market saying, okay, now I want, and as we know, the home is such an important asset for Chinese. It's either cash or property has been typically one of the first things you buy and you spend a hell of a lot of money on it. So at some point, the price of new homes has got to start looking attractive. Are we nearing that yet, or?
So from I guess, financial sort of valuation perspective, we are seeing property prices get into a reasonable area. But I think it's very different from a South African perspective. So as an example, hopefully people can hear me better.
I said a point here that the sound was a little bit bad, guys, so apologies for that. We moved the speaker a little bit closer.
So yeah, my point is, so property prices are getting more reasonable. So historically, Chinese short-term interest rates were around 3.5%, and rental yields were around 0.5%. So you're having rental yields being 1/7 of your short-term interest rate. So it just didn't make sense from an investment perspective unless you were just speculating on the capital value of the property. Right now, what we are seeing, even in tier one cities like Shanghai, where it's really expensive, yields are now around 1%, and short-term interest rates are around 1.4%. So that gap has narrowed massively. But it's probably still a little bit way to go where your short-term interest rates and your yields start matching, especially your net yields. So we'll see. I think property prices are getting more reasonable. I think we've been of the view, I think anyone that watches our webinars over time, is that we've been of the view that property is going to be a drag on the economy for the next decade. We started saying that 2 years ago. So let's say there's another 8 years to go. And within our portfolios, we are staying clear of properties.
Yeah, great. And that's just a result of the over expansion. So the government said we'll build cities, we'll build homes, we'll just put this capacity in place, but it didn't come. Now they can pivot the economy quite quickly, which they are doing in every aspect, and so are happy to allow that property glut to reduce.
Yeah.
And I guess we'll talk a little bit later around where it's pivoted to. But if you look across industries, the government does support. Tian, maybe just, I don't know if you want to address it now, but the concept of the regional governments taking control of the capital spending. So the central government says we're going to do something, and then it's the regional governors, or the what they call the mayoral economy, where they actually go and deploy capital to build up infrastructure in particular regions. Is that something you want to chat about now or a little bit later?
I mean, I can cover it quickly. So as an example, one of the key areas China is really trying to invest in, I'd say two key areas, is electric vehicles and then your semiconductor and AI sector. So every single, I wouldn't say every single, most regional governments will be having supportive policies for those specific sectors. And if you look at a lot of the growth coming through, I mean, exports here would be a massive growth, and electric vehicles will be a big part of that export growth number, as an example. And a lot of that will then help offset the declining contributions of the property sector. It's not ideal to have declining properties for the next 8 years.
Sure.
If it does happen, we have pessimistic assumptions, so we would be quite happy if we turn out
if
to be
it's 6 years.
Yeah. So overall, I think China's got a right balance. The policymakers, they are very competent. They're not perfect, but they are very competent by global standards, and I'm quite confident in policy direction.
Yeah.
Cool. I'll carry on. PMI numbers are just stock standard. I think the blue lines on these charts are more private sector focused, and the red lines more state-owned enterprise focused. So it's actually encouraging to see private companies more confident than a state-owned sector, which makes sense. So there's quite a high youth unemployment. So one of the things the state-owned enterprise have been told to do is that, hey, you guys go employ 5,000 graduates. I don't care if there's nothing for them to do. You need to pay them a salary. So these sort of things happening, which is great for employment reduction. Unfortunately, it doesn't help with the confidence of the state sector, who then have to get told what to do. Private companies don't have to do that. And as a result, we think, obviously, this is one contributing factor. But yeah, private sector, you can see way more confident into these surveys.
Tian, this has been an interesting, call it, evolution of the Chinese economy. Is obviously we have this massive view, and it is a centrally run economy by the central government. But what happens is that through the reform, they've allowed more and more individuals to go into private and support that, because they've recognized that innovation and the growth of a business does take up the employment rate, but also the innovation. So this entrepreneurial drive in China is significant. And you have shown a graphic before in terms of patents being listed or signed or given in China. This is something I think we forget about, having been so far away. We look and think about the US as being a significant innovator, but China's actually at a level certainly taken this on and looking to potentially exceed from an innovation perspective. So often you say, well, China copies, and then innovates around what they've copied. But actually, what's going on here, and also with Chinese professionals and academics that are trained in the West are going home because of this. They're very happy to go and find future employment in China instead of staying in America. And is that sort of what's driving this? And I guess the point I'm trying to make is that the constant innovation will drive this economy further.
Yeah, absolutely.
Hopefully, I haven't been drinking too much of the Kool-Aid here, and you can confirm this.
Yeah. So I think definitely private sector is getting back, especially, I mean, in terms of the tech sector. I mean, with Jack Ma meeting Xi Jinping a few months ago, maybe it was late last year, a public display of official policy support for private sector, especially the tech sector. I think it's very, very encouraging, and it shows in the confidence data. This hopefully translates into real economic data. I mean, you mentioned the innovation from China. We heard a rumor the other day that within Meta's AI team, the American employees have sent an internal complaint letter. I don't know how true this is. So I know this is a public rumor. This is just rumors, by the way, is that the American employees are complaining that the staff are talking about jokes in Chinese and they don't understand and feel excluded. So it just, again, it talks to the point of the Chinese being innovators, and within a lot of the core AI teams, even of global firms, there are a lot of Chinese employees, and it's obviously a result of a lot of the sort of STEM and the science-based graduates that China produces, and it's really got a lot of potential, especially in the tech era that we are entering into. So we are very bullish on the sector. Valuations in the sector are another story, which I'll cover later, but we're very bullish on the sector. So this slide talks to the inflation and short-term rates that I mentioned earlier. What I think is quite a positive on this chart is where this green circle is. We've seen the 30-year rate. I mean, 30-year government bond rates were lower than 2% at one stage when retail demand for government bonds just started going crazy. They've normalized a little bit, which is positive. We are hoping for the short-term rates to also normalize a little bit. With that, hopefully, the money going from bonds into equities. We still haven't seen massive retail flows into the Chinese stock market. If we look at valuations of Chinese equities, they are still much, much cheaper than US and Indian valuations. The other two very hot markets right now. You can see China having a bit of a rally there, getting to cyclically adjusted PE ratios at a market level closer to 18 now. So closer to its historical average, but still on about a 55% earnings multiple discount relative to the US and India. So very, very attractive still, even with the recent rally.
So before we came on, Tian, we were talking about Hong Kong mainland shares and so China mainland shares and those listed in Hong Kong, and you've had a significant rally. I mean, what do we say, up 60%? So even though you've had that, you've still got a CAPE ratio that's significantly behind the others. What do you think is what unlocks that valuation gap? What means, how do those get closer? Does China rally another 60% from here, and is that probable?
Yeah, I think. I mean, the typical behavioral finance sort of question is, or my answer.
Mean reversion.
I would say, I mean, last 3-4 years, China was just considered uninvestable because it was such a prolonged bear market. It was sort of a value market that turned into a deep value market. It just kept going down, and I mean, emotionally, investors just turned away from China. I think with the recent rally, a lot of people, I mean, a lot of your hedge funds, your fast money is already in China. A lot of your long-only funds and strategies are now starting to look at China. And I think the first trigger would be people must just be aware that China is really not an uninvestable market. China is the second biggest market in the world. It's a $20 trillion market as we speak. You can't ignore it. And once global investors wake up to the fact that China is going to be here for the long term and start allocating, that'll be a natural trigger. And obviously, when earnings start to pick up as well, these earnings multiples also start to pick up. I think we've got a lot of potential.
So Tian, that is, I mean, obviously we know what's going on in the S&P 500, the Mag 7. China, this is probably Tencent story and related tech, Alibaba, etc., etc. But obviously, what we're not talking about from a China perspective, there's a massive market outside of that in industrials, etc., etc. I mean, those just poised with everything we've said around consumption rates. They've got a 5% GDP growth number. You know, the rest of that economy starts to rise as well. So there's opportunity outside of just China tech.
Yeah, absolutely. I think I'll skip this slide, and I'll come back for it. And this slide will. Sorry, I'll skip these slides. I'll talk.
Sorry, I may be jumping ahead
correlation.
here, but maybe let's come back to it if we can.
I will come back to the previous slides, but linked to your question, exactly as you say, and it's very much linked to the correlation. So this chart talks about correlation to the JSE, and for most South African investors, especially Reg 28 focused investors, JSE will be the biggest part.
Sure.
MSCI emerging markets is often historically been used. I think MSCI emerging markets probably very relevant a decade or two ago, but right now on long-term correlation is about 90% to the JSE.
To the JSE.
It's not a good statistical diversifier. MSCI China, which is the market where China tech, the market, what you mentioned now, it's still got a 70% correlation. This is where Tencent, Alibaba is. Obviously, Tencent really increasing that correlation factor to the JSE. Where we like to also focus on, without ignoring MSCI China, is the CSI 300. That's historically got a 40% correlation to the Chinese equity markets, and that's where we feel you really need to get exposure, and that's the part of the market you mentioned now, where you've got exposure to Chinese hydroelectric dams, like the biggest dam in the world, the Three Gorges Dam, where you have exposure to Chinese rice wine that you've never heard of in the West. I mean, we went to China, it tastes like liquid fire, but it's something that's very, very premium, draws high margins, and very well sought after in the Chinese market. You're getting exposure to companies that you're not familiar with in the West that offer tremendous value and opportunities. That's what we like to focus on that green bar.
So maybe just talking to that, what we often hear is if people or clients are going to take exposure to emerging markets, it's the MSCI EM. But therefore, what they're probably not doing is, and even by the MSCI World, being considerably underweight mainland China. Because you're getting the Hong Kong the H shares as a big component.
I mean, not just of underweighting main shares. So as an example, within MSCI Equity, the US is about a 65% weight. I might be slightly off, but US equities are about 65% weight, and China is around a 2.5% to 3% weight. So it's telling you that China's market size is 1/20th of the US market, but in reality, the US markets are about 50 trillion and China's about 20 trillion, by far the second largest market in the world. So it's hugely, hugely underweighted, and that's why we don't like to, especially for China allocation, we definitely urge everyone to really do a top up on that MSCI Equity or even MSCI emerging market. It's just underrepresented in these, at least MSCI indices. I can't speak to every index out there.
Sure. Let's go back. I think it's worth going back to those slides that we jumped.
So I think some of the slides I skipped. I think this slide is fairly important. So Chinese household deposits. We obviously see this is in trillions of CNY. So let's call it around the 7.5 mark. Every 7.5 trillion CNY is $1 trillion US. So in 2022, with the COVID lockdowns, the Chinese saved almost 18 trillion CNY, or what's that? Almost $2.5 trillion just in 1 year. Just in 1 year. You've seen a downward trend. A downward trend is what we want, because less money sitting at the bank means more consumption and more investments. So these are just fixed deposits sitting at the bank. 2025 year to date is still lower than 2024, but unfortunately it's looking like we're going to surpass 2024. So confidence levels are not great in terms of setting aside money for a rainy day, kind of feelings. But the good thing is that right now we are sitting on cumulatively $23 to $24 trillion of cash in the Chinese banking system, waiting to do something as soon as that confidence trigger.
And that's just households.
That's just the house. I guess, it wouldn't include sort of corporate institutions. Yeah, this would be your retail deposits.
And you've got capital controls in China as well.
Yeah, so you can't take it offshore.
So if anybody's looking for a return, I mean, I think the number you quoted about 2 years ago that I remember was what percentage of the Chinese investor retail market is in the stock market?
Mm.
It was like quite a small percentage.
Yeah, definitely small percentages, even smaller percentages that keep money in the stock market.
So you change that sentiment through government, again, stimulus and opportunities to get benefit from maybe tax savings. That money moves in and would move that share market substantially, potentially, as a theory for
Yeah, so I mean, retail retirement annuity products have recently been launched. When I say recent, 4 years ago. So what we've been used to for decades in South Africa, in China, they only started that 4 years ago to give tax rebates for retirement investments. But unfortunately, not all of it is forced into equity markets. So you can choose bond funds or money market funds, etc. A portion of that will go into equity markets. New insurance company premiums, 20% is mandated, or if you state on 20% is mandated for the equity market. We have all of these policies directing flows into a sustainable equity market, which is positives. Now we need, these are purely discretionary deposits. So ideally we need a decent portion of that 23-24 trillion dollars to flow in. I mean, even $1-2 trillion flowing into equity markets will be hugely positive. So we got a lot of potential. Even though the markets rallied quite hard, we are still below 2021 levels. I think this chart will show, I mean, year to date, China onshore has done almost 24%. This is as at the end of September. October will be slightly higher, depending on how the markets do today, actually. And then Hong Kong up 35%. So both outperforming the S&P 500 for 2025. Hong Kong very much outperforming the S&P 500. We've been through this chart, so I'll skip that. Yeah, I think moving on to how our funds have done over the periods, our funds obviously done very well. This year, I think our Prescient China Balance Fund, I think I need to brag a little bit.
Okay, we'll allow it to you, just this one.
It is our flagship strategy. It's our fully flexible sort of all-in-one China strategy. So China.
I'm always like to interrupt you on this, and apologies. The South African market, obviously, we have spoken about that. I want to reiterate, is a balanced fund. We typically know in South Africa as a spread, not a 60-40 portfolio, but you're saying this is more flexible. It won't have a static strategic asset allocation to bonds and cash. But we use the term balanced in that it would balance effectively out the equity exposure by using fixed income as a hedge against. So it's not a, just making the point here to viewers is that it's not the typical SA like balanced fund.
It's fully flexible. I guess 13 years ago when we decided on the name, probably didn't think of that, but it's fully flexible. We can go up to 100% equities. In fact, last week we were at 98% equities. As we sit now, we're about 88% equities, looking to add more as well, depending on how, if there's any positive developments, further positive developments out of the APEC meetings. But it's a product that gives you access to MSCI China, gives you access to CSI 300 China fixed income, and on top of that, we use derivatives and arbitrage opportunities to enhance return. I'll skip the sort of marketing portion, but basically we are trying to provide you an enhanced risk-adjusted real return, which we have been able to achieve, and I'll show on the next slides. So far this year, we are very bullish equity. So as at the end of September, we were 92% equities. During the month of October, as I mentioned, we were at one stage up to 98% equity exposure. We manage asset allocation on a daily basis, so we very actively manage it, and it's a track record that we are proud of. So this year, some of the key changes you would have seen for long-term investors in our fund is that for the first time in a long time, you are seeing counters like Tencent and Alibaba within our top 10. And this is as a result of our overweight to Hong Kong late last year. because it was just extremely, extremely attractive. Hong Kong is about a third of the size of the onshore market. So Hong Kong is about $5 trillion, whereas onshore Chinese equities are $15 trillion. That's why, even though we historically do have exposure to Hong Kong, the stocks in Hong Kong wouldn't feature in our top 10 because the onshore market is just so much bigger. But this year, because we had a significant overweight, which has done the fund very well, you're now seeing your tech counters that you're familiar with in our top
Just
10.
if we may just quickly cover some of those.
Mhm.
Obviously, Ping An is insurance company. The next one, Contemporary
So, I mean,
Empirics.
highly diversified industry. So Ping An's insurance company, Contemporary Empirics, that's CATL. It is the world's largest battery manufacturer. So they supplied, they even supplied BYD, if I'm
Yeah.
not mistaken. So they supplied Tesla, they supplied Mercedes, BMW, they supplied pretty much every single electric vehicle maker. Guizhou Maotai, it used to be the biggest company in China. It might still be, so within our portfolio, it's obviously number 3, but it is the premium rice wine producer.
That's the one we tasted.
No,
No.
we couldn't afford that one.
Okay. So that's not a beer company.
No, it's not a beer company. Yeah, it's probably the most premium rice wine company in China. Alibaba, you guys know, China tech,
Yeah.
online commerce, cloud, AI now. China Merchants Bank, as it is the bank. Tencent, everybody
we
knows.
know well.
Tencent and mining, Zijing Mining is just one of the big mining groups in China.
Diversified mining.
Yeah.
Okay.
And China Construction Bank, another bank. So a couple of banks, 8 or 9, a couple of, and then BYD, obviously, you're probably the most competitive EV manufacturer and battery manufacturer in China. So
and making a big dent in South Africa and to come.
Absolutely, absolutely. So as you can see, it's very highly diversified, sort of in terms of sectors and counters within our equity portfolio. Our Prescient China Balance Fund, we're always proud of the fund when the equity market does has a strong year in terms of returns. It's always difficult to keep up, even with a fully flexible man, because it's a multi-asset strategy. And even with that, we have beaten the market year to date, or I guess it's 9 months of returns. We have beaten the market net of fees by 1% this year, so we're very proud of that. These are just long-term returns. Long-term, we have done China CPI plus 8.5, so very proud of that. And this is our proper brag slide. So this was never intended, but I think I show this almost every webinar, is that our Prescient China Balance Fund has beaten 100% equity indices. So all of these indices, the green line MSCI Emerging Market, total return, all of these are total return indices. There's the MSCI China, the gold line, and the CSI 300 total return, the red line. Our fund has consistently beaten 100% equity indices since inception. So
Tian, the benefit of the mandate is that when you see markets are maybe a little bit extended, you can use the derivative exposure or take your equity exposure down, meaning that you're not taking the drawdowns as significantly as what the equity indices are doing. Re-enter the market again when it's appropriate. So your net equity exposure over time, what you're really trying to do is make sure that you miss and the big drawdowns and get the uptick on the upswing.
Yeah,
I mean, effectively what
especially for a market as volatile as China, we believe you really, especially for non-institutional investors that don't have a full asset allocation capability for China specifically, it's a whole different beast on its own. We certainly recommend a multi-asset strategy where we can manage the downside and the volatility.
Yeah, so what a lot of people say to us, I can get China exposure through an ETF. So effectively what you're doing is you're buying a cheap exposure to the CSI 300, you're getting that index exposure without the technology or the overlay that from an active component you're able to, I guess from a systematic perspective. So Prescient is a systematic house. There is a strong quants process behind this and following very much the mantra of the way we do things, but looking at an index level. But because this market's so diverse, to create the differentiation, you have to do something slightly differently, which is then using derivatives, for example, to take out or create the protection that we require, therefore giving you the benefit of beating that index. I mean, that's really the a key point.
Yeah, absolutely, absolutely. So, very much on point. I think that's what we aim for in the strategy, and we don't want to take massive bets either way, or concentrated risk. Ensure that risks are all diversified out. Let me jump through. So this is I guess another brag slide. We are ranked. We are literally the best China multi-asset fund in the world. By definition of the world, the Morningstar world, which is effectively your entire fund universe globally. So on the 10-year, you'll notice the percentile rank is number 2. But we are second percentile out of 42 surviving peers over 10 years, and that means we rank 0.84 out of 42. So we are ranked number 1 over 10 years as well. So we're very proud of that. And obviously the returns on the previous slide is a reason why we are ranked.
And importantly, I think that, the 5-star Morningstar rating is, that's an independent rating. It's not, while you're bragging, it's independent.
So I think this quarter, I mean, being in South Africa, one of the things I've been chatting to quite a few of our clients is our Prescient China Gear Fund, which I don't cover a lot on the webinar, but this is something that we typically recommend entry into. It's our China hedge fund, but it's a very safe hedge fund. It's something we recommend our clients consider putting into at December every year. So this is something where it's an extension of our China Balance Fund, but we have derivative structures in place so that in local currency terms, from 1 January to 31 December every year, we try and target a maximum drawdown of 5%, meaning in all likelihood, from 1 January to 31 December every calendar year, you're not going to lose more than 5% in domestic currency terms under most
CNY.
Market conditions. Yeah. And because we put a hard stop loss with an option structure, so it reduces a lot of the volatility of your China investment.
Tian, this is available to investors, but it is a qualified investor hedge fund. It's not a retail.
It is a Section 65 approved hedge fund, but there is a minimum. So we have a standard minimum. It's around $120,000.
Okay, so accessible through international platforms.
Yes.
So international platforms. Somebody has taken discretionary money offshore in dollars, can access this on certain offshore platforms. It is a qualified investor hedge fund, not available retail in South Africa.
Yeah, I'm going to skip through the animation, but I think if you look at this slide, so this is essentially the Chinese equity. The green line is Chinese equity since May 2022, when the dollar version of this fund was launched. All of these numbers are converted into CNY, just to show you how it controls the volatility. So when markets are really crashing down, it really protects on the downside. So you're getting a much, much more smooth experience. You may not end up outperforming the equity markets as easily as our balance fund, but when markets are very volatile on downside in China, it makes the ride a lot more palatable. So it is a product that if investors do want to come in, we have some clients switching some from the balance fund into the gear fund because they just want some volatility reduction for the next year. We typically recommend, if you want to invest in this fund, come in December and stay for at least 1 year within this fund. Obviously, we always focus on the long term, but I would recommend something of a minimum 1 year in this type of product. It offers monthly liquidity if you do need to get out sooner. So that's pretty much the selling point. And if we look at the onshore, so this chart is the pure onshore domestic currency building block of the exact same strategy as our Prescient China Gear onshore component. You can see the green line again is a CSI 300 and the dark blue line or the black line on the screen here is the actual fund performance. And you can see just with that superior downside control, it makes your entire China investment experience a lot more palatable if you are someone that likes to look at your NAV prices every day. If you have a 5 to 7 year horizon, then the two funds between this fund and our Prescient China Balance Fund, the returns should be quite similar over the cycle. Yeah, and I think that's it. We are definitely continuing on our China journey. We're very committed to it. And I would say we are the only South African investment team in China. We are one of the few global managers with a core investment team based in mainland China. And and I think our track record speaks for itself. So I think Almost
Yeah,
running
we
out of
almost run out of
time.
time.
So we'll try and get
Let's
to
go to some questions. Thanks, folks. Tian, I apologize for jumping in, but hopefully it made the discussion a little bit more entertaining, interactive. Some questions, while you read the questions coming up on the screen, maybe one that I sort of just, not a question, but a point is, we're seeing in South Africa a lot of Chinese EVs coming in. We've got Jetour have just launched a new vehicle, I think, which is part of the Cherry Group, at a significant price point that makes, buying one of your premium label 4x4s eye-watering compared. BYD are laying down a significant number of charging stations in South Africa, committing. We've seen Chinese companies, motor companies, coming in, putting in factories with parts, or rather warehouses, to support. There's the new iCar coming from Cherry, which is, I think, going to contest the Suzuki Jimny market at a very significant price point. We've heard that in the UK, BYD is challenging the consumer market there. I mean, the China EV story is significant. I mean, that was all around battery technology. Just where I'm really going with this is that China has solved the renewables puzzle. What we're seeing in the Mag 7 is that these data centers, they're becoming energy companies. And the requirement to fuel those data centers, the actual big problem is becoming electricity. China is on a massive tech drive. We know the semiconductor story. We know what they're doing in their own race for the AI, deep sea, data centers. Do you think that the China energy story means it's not a problem, and therefore could be quite a strong contender in this AI race? There is a race between the US and China. And is the energy story potentially the solution to who may win this?
So, I mean, on a dollar for dollar basis, I'd put all my money on China, because just power is
You're not that you're biased.
Yeah, not that I'm biased. Every single sort of component that you need for the AI race in China is more affordable.
Okay.
Obviously, the US has a lot more money than China. So on a like-for-like basis, US has a lot of capital. Even though their power is more expensive, they still have the best chips. China arguably now has the best software because they need to do with lower processing power. They have ample of electricity. It's going to be a very interesting race to watch. You're very much right. The energy is so critical. Unfortunately, South Africa struggles with energy, but my understanding is that even the country is getting better. But let me get back to the questions before I turn. I actually have another meeting to run to.
No problem.
So there was questions on if we have a feeder fund version of our China balance. Yes, we do. It's available on pretty much every single investment platform in South Africa. So just have a look, or you can just come directly to Prescient there's a Prescient China balance feeder fund.
Yeah. So listed on domestic, and then also in the international platforms that are well known to everybody, South African and foreign aligned international platforms. If the fund is not on the international platform, by request we can add it, but we are on all of the major domestic fund list platforms that have an international affiliate sitting offshore. Our China balanced and China equity may not be there, but certainly China balanced. If anybody has a preference for the equity fund, and then obviously the hedge fund one can come directly as well.
Yeah, so we make our funds available on every platform that wants to load us. So if your platform doesn't have it and they're willing to add us, you can just get in touch with one of us, and then we'll.
Often there is a demand request, so the platform will say to us, please demonstrate demand. So if anybody does have the request, we would like to be able to share your details with the platform, specifically the BDM, so they can go and motivate the case to have it added if it's not there. But please do check with us. As I say, we have got it listed on the majority of the platforms. There's been a request for Tian's email address. We'll send that out. What else? We may have missed one or two other questions.
I think there was a question on Pinduoduo. We do have indirect exposure within we have a neutral exposure. So we are not too optimistic on sort of growing profitability for Pinduoduo. I mean, this is probably also based on management's own expectations of the company, but overall it remains a very competitive business in China, and we don't have an underweight position to the company. We probably have a neutral view on the company currently within our portfolios.
Okay. Tian, I think just in the interest of time, let's cut it there. If there are any other questions that we haven't answered, we will come through and email you directly.
Yeah.
But folks, in closing, to say thanks very much. We had over 200 people join us today. Obviously an interesting topic, Tian. Your insights are always very valuable, being on the ground, keeping your ear to in the market there, what's going on. Obviously, the performance speaks for itself. I think the future state of where the world goes, we know that there is a battle on for the dominance of, you know, the power shift, I guess, is, does it stay in the US? Is it moving to China? Folks, the argument that we make is that if you look at the global markets, there certainly has been a very strong Western story. And if you listen to market theorists and those that predict the future and cyclical change that goes on around the world, I think we ignore the East and the Far East at our peril. And I think if we just see what's going on around, certainly the arm wrestle around dominance between the presidents, this tussle is real. But I think if we look back in the next 5 or 10 years, to my mind, and you know, don't back what I say, is that there certainly is a shift happening, and I think there is going to be not necessarily a winner or a loser, but certainly some of the power will move, meaning that our jobs as people that engage clients and manage money, we need to be cognizant of allocating capital, you know, at a fiduciary level and making sure we do the right thing. What we advocate is, because the indices are maybe somewhat underweight China equities or China specifically, for whatever valuation reason, that one does take a compelling look at a China exposure, and potentially not just through you know, a broad-based fund, but actually a specific geography. We do appreciate that that in itself has some challenges, but I think if you just look at some of the metrics that Tian has shared with us today, it certainly is a compelling option. Thanks for joining, Tian. Thanks for being here.
Yeah, feel free to grab us. I think we've sent out some replies with my email address. Feel free to get in touch directly. If you can't grab me, grab Murray. And he will point you to.
And our BDM team around the country, folks, have got everybody's details. And we, you know, please look on the website, or we will more than happy send you information and come and share with insights, which we have plenty of on the China story and of course our own funds. Have a happy Friday and good to see you all. Thanks for taking the time.
Recording of this, will be available on YouTube within the next few days. That was the long. Okay, great.
Cheers, everyone.
Bye-bye.
Thank you.